Us here at CJ Capital Management are all about spreading the wealth. And when the market is down like 2023 is supposed to be, it's the perfect opportunity to make a ton of money. As you can probably tell by our fancy lion design on our channel banner, we are a very sophisticated wealth management firm that definitely oversees billions of investors' dollars. Just please don't look at our QuickBooks. Seriously though, we believe our 2023 strategy is going to turn our billionaires into trillionaires. So strap in, grab your favorite beverage, and sit back as we go over step by step how to become rich while markets are looking bad in 2023. Step 1. In order to become rich, first you need some starting capital. Now this number doesn't have to be large, but the more you have, the more you can make. So take a look at all your crypto wallets and pull out the last few cents in Dogecoin you still have, because now is the time to invest in some real assets. If you don't have pennies left from your 2020 crypto wallet, maybe try mowing the lawn for your elderly neighbor, or go scoop up the coins at the bottom of a fountain. Either way, you need to acquire some capital before you can do anything. This is honestly one of the most important parts that people forget about. Obviously, there's zero millionaires watching a how to get rich video on YouTube, but in order to build wealth, you at least need like a solid base. One way I made some money when I was first starting out was buying and selling baseball cards on eBay, which honestly was super fun, but it also gave me some extra investing money. Just go on YouTube, search up top 10 side hustles, and start grinding out those online surveys. Now, during times of economic downturn, it is pretty important to have your money in cash, or at least very liquid cash equivalent investments like money markets, CDs, or time deposits. Although these holdings are not going to get you rich, you are at least going to be above the market, which is really the most important part, especially with the money you are not actively investing. Obviously, you'd prefer to have this cash working and make more money, but timing is everything in down markets. So holding on to a little extra cash won't hurt you. So instead of asking Santa for a Squishmallow this year, try to get that stocking stuffed with Benjamins. Step 2. Now that you have your money, it's time to put it to work. And the only way to make real profits in recessionary times is to take risk. Now, I'm not talking about throwing your kid's college fund on some AMC puts like you're trying to blow up on Wall Street bets, but you will potentially lose money, which is why I want to remind everyone that this is not financial advice. Please do your own research before investing into securities of any type. Kind of like what I mentioned in my video on the highest growing stocks during a recession, you really need to find industries that have proven success during high inflationary times, like healthcare and consumer staples. Technology and energy often experience really high growth in recessionary times too, depending on the company. If this were a video on how to stay afloat during a recession, I would tell you that ETFs and REITs in these sectors will be perfect. But we're not just trying to get by here. We've got piles of money to bathe in, and we can't let a bullish market slow down that process. In order to really get our money right, it's time to talk about leverage. Now, in finance, leverage is any way of using debt or borrowed funds to increase your investment, and in theory, maximize your potential earnings. Some of the most common and easiest to use forms of leverage are leveraged ETFs. Now, a leveraged ETF are usually a security that uses different financial derivatives and debt to amplify the return of an underlying index. While most ETFs typically track the securities in its underlying index on a 1-to-1 basis, a leveraged ETF will try to magnify that with a 2-to-1 or 3-to-1 or even more ratio. As you probably know, ETFs are usually a reflection of an industry or market, which means that a leveraged ETF will expose you to more risk and more volatility in that industry. So if there is a little price drop in an industry, the leveraged ETF will show a much larger drop, and vice versa. Many of these leveraged ETFs either derive from other ETFs or reflect the opposite, as they go up when the industry goes down. Any ETF that says leverage short will reflect the opposite as to what the market is doing, so pay attention to the names. Now, these leveraged ETFs present a much easier way to get involved for investors that either are not as educated on more advanced financial instruments like puts and shorts, or just don't have the capital to do that. We believe that if you do the research and find an industry that you believe in, holding leveraged ETF shares of that industry or leverage shorting shares will give you the opportunity to make the most possible money. And with a lot of industries struggling in bearish markets, putting your money into leveraged short ETFs in industries that have historically struggled could make you rich. Or you could be explaining to your kids why they don't have a college fund, so make sure you do your research. While other financial instruments like shorts and puts are a great way to expose yourself to high amounts of risk, we feel that these tools are practically gambling if you don't know what you're doing. So we really don't recommend them to anyone that is not an experienced trader, as they really should only be used to hedge risk. Step 3. It seems pretty obvious that higher leverage will get you higher earnings, but actually finding the investments that pan out are extremely difficult, and the potential for huge losses is pretty high. but we believe it is almost impossible to lose money if you invest the right way. In order to get the most out of each of your investments, there are many factors that go into it. First off, finding an industry or stock to pick is probably one of the most difficult challenges. In times like now where interest rates and inflation are high, we should probably stick with the companies that typically perform the best and are in those industries we talked about earlier. Many of these, however, are more defensive stocks, so you should probably use the industries as a general place to start and do a lot more digging into specific companies in the industry. Typically, smaller companies have the largest room to grow, with booming industries like energy and technology oftentimes flexing the largest growths we have seen in recent time. Because they have a lot of room to grow, it does also mean their price could be much more volatile, as many smaller cap companies' prices are much more reactive to market news as a percentage compared to larger cap companies. But if you are just solely going for the highest growing company, we would recommend finding smaller companies that are increasing their market share in their industry that also have a unique competitive advantage that sets them apart from others in the industry. There are a lot of amazing free tools like Yahoo Finance and Thinkorswim that show a ton of information and are really useful when trying to find that needle in the haystack. Now, if you do want to go the more traditional Warren Buffett route, then you might want to start looking through 10Ks, as they show everything about a company inside and out. We're not going to go into a ton of actual stocks, as we already have a lot of videos on high growth stocks, and we think leveraged ETFs might give you the better alternative, but we do want to cover one example. Marvell Technology is slowly taking over their industry. Now, I'm not talking about Peter Parker and Bruce Banner. Marvell is a chip maker with strong focuses on data infrastructure, computing, and storage sectors. With many analysts noting that Marvell will have a bright 2023, they made headwaves after releasing their Q2 earnings with a net income of $4.3 million and revenue of $1.5 billion. Drastically beating their year-over-year earnings. Their market is expected to keep growing above 10% through 2030, and the spending on enterprise networks is expected to grow at an average rate of 5.3% annually for the next 5 years. So their future is looking solid, and I think it makes them a great example of a smaller company kind of on the rise. So in theory, the best way to see the highest amount of growth is to leverage your holdings into volatile stocks that are the riskiest. Now, we really don't recommend this, as you can scroll through Wall Street Bets losses and see all the fellow investors that took one options trading YouTube course and started throwing away their money like a Drake steak advertisement. But we did want to present this information as it can be useful in the right context and with the right amount of research. In conclusion, in order for your investments to get you rich, you will either need a lot of capital to start out with or a lot of leveraged risk to make large amounts of money. Which is not to say it's impossible, but it will take a lot of research and effort to find investments that will succeed. Even the biggest firms in the industry struggle to beat the market, so expecting to find someone on YouTube that can is actually kind of funny. But if you're still watching this, thanks so much for making it to the end of the video. I've been working hard on a lot of videos lately, and if there is anything specific with finance or the stock market that you all are curious about, please let me know in the comments. We really appreciate it if you could subscribe. If you absolutely hate this video, definitely hit that notification button so you can leave some nasty comments in all my future videos. I'll see you around.